Canada has cut its policy rate by 25 basis points to 3.0%. That is in line with expectations. The Bank of Canada drops rate guidance as tariffs brew. These are headlines from Bloomberg News. The Bank of Canada's decision, the opening remarks have been made as well. The Bank of Canada cuts rates and warns of economic shock from the tariffs. Here's a story from Dow Jones, which is moving on the Bloomberg Newswire. It's written by Paul Vieira at Dow Jones. He has been in a lockup where he has had an advanced look at the Bank of Canada statement and has had the time to prepare a story. Here's what he says. The Bank of Canada on Wednesday cut its benchmark rate for the sixth consecutive time and warned of a significant shock to the economy from a U.S.-Canada trade conflict with tariffs of up to 25%. Here's a quote from the Bank of Canada statement. A long-lasting and broad-based trade conflict would badly hurt economic activity in Canada, according to Tiff Macklem, saying that tariffs would also push prices higher. Warren Lovely, any surprise there? Any reaction?
No, I think, Paul, as you indicated, everyone was prepared for this interest rate decision. All forecasters, markets had discounted a 25 basis point rate cut. Who doesn't like round numbers? We've moved now from 5% at its peak to 3% now. 200 basis points in 6 meetings, a faster tempo to interest rate relief in Canada than almost anywhere on the planet, reflecting what has been a pretty significantly underperforming economy, and now one that faces, as the Bank of Canada has just outlined, a pretty serious economic threat in the form of U.S. tariffs, if those do come in short order.
Earl.
Yeah, dropping guidance, in my mind, opens up their flexibility, their ability to cut more if they need to cut more. So I think that increases the probability of us going below 2.5%. Having said that, similar to what Warren said, I think the market largely discounted like a flexible approach because the currency is largely unchanged since that announcement came out.
Okay. And Devlin.
Yeah, I mean, let me take a step back. I'm going to give kudos to the bank. You know, I'm still in the camp that the biggest risk that we face is deflation and going back to zero interest rates, close to zero interest rates, in a very negative economic environment, and we kind of run out of bullets. So the faster, we had to move up aggressively, and they moved up aggressively. I give them kudos for that. And they are moving down aggressively, and I think I give them kudos again for that. And I would encourage them to keep doing that because, the faster we can get rates lower, you don't want to be, with the benefit of hindsight, too restrictive because that increases the probability we get to that danger zone, which is back to near zero interest rates. And I'd rather have them move aggressively, and I think they have. And this makes sense to me. I'm more in the camp they go to 2 than like 2.5 this year. And I think the risk is below that.
And there we saw some dollar reaction. We'll just put that back up on the screen. I'll get Warren Lovely's take on what the thinking of currency markets is as the loonie gets bid down to 69.25 cents roughly, and you can see it moving down sharply at. Actually, it has moved higher. It was down prior to the announcement. It has moved slightly higher in the minutes after the announcement. Warren?
Well, that's the Canadian dollar versus the U.S. dollar, and perhaps appropriate to be thinking about it, given that today we'll get not just the Bank of Canada interest rate decision, but this afternoon a decision by the U.S. Central Bank. And we really do have a tale of two economies here, one where characterized by resilience in America and one characterized by underperformance and a massive outsized shock, perhaps right in front of us. So hard to be too constructive on the Canadian dollar here, in my opinion, and you really do see significant and I think quite lasting divergence in interest rate policy, Bank of Canada versus the Fed, and that's no tonic for the Canadian dollar.
Earl, you've paid a lot of attention in recent commentary to the rising rate of unemployment in this country. How much risk is there to the employment market from U.S. Tariff policy?
It's actually not a simple question to answer. And the reason why it's not a simple question to answer, there's two components to that. We've been talking about the tariffs and the possible economic shock. But remember, 75% of our trade's with the U.S. U.S. is running hot. They're running probably about 2.5% of real growth this year and possibly could go up to 3%. If that happens, that's still a benefit for Canada, and that's still good for our job market. I think the word that Warren used, which is the right word, is underperformance. It doesn't necessarily say deterioration because it's dependent on U.S. growth as well. So we're watching it. We think above 7%. If we hit that, we're at 6-7 now. The Bank of Canada accelerates the eases, but between 6.5 to 7, they're basically watching to see what happens.
Earl, what are the implications for fixed income investors from all of this?
So I think that, broadly speaking, it's still a bull market for fixed income. We like the U.S. more than Canada, but recognize the underperformance of Canada. But that's largely been priced in. If you look at the difference between Canadian interest rates and U.S. interest rates, it is the widest that it's ever been in my career or in Bloomberg's data that you can see. So, as Mark Carney famously said, there are limits to which monetary policy can diverge. At the time, that was the reverse in 08-09, and it was the Canadian dollar at parity. But I think that, we'll see what causes it, if it's tariffs and other shocks. But, I think that there will be limits to how much the bank will go independently, aggressively from here. They might be doing 25 and 25 and differing from the Fed. But, it will be reflected in the currency, which is kind of what they want. When the currency gets weaker, it eases financial conditions, just like lower interest rates ease financial conditions. So it's self-reinforcing. It's not a problem.
Warren, what questions do you think journalists should be asking at the press conference later today? What would you like to hear?
Well, I think it's going to be pretty hard to get around the bank's thinking on tariffs, and in particular, this whole interplay and reaction function, tariffs, retaliation, GDP, inflation, monetary policy. Earl already mentioned, and I think this is appropriate, and I agree with Earl, not as much attention has been placed on this, but what does the reaction function look like from governments too? We know that in this tariff scenario, there'd be, of course, an argument for weaker growth and more monetary policy relief, lower interest rates. Both Ed and Earl are talking about that. I totally agree. But what about the government reaction here to disaffected workers, companies, industries? That we have to control for as well. So beyond tariffs, if we can look past it somehow, I think maybe as well, the odd reporter might want to know, well, you had some optimism with respect to the economic outlook. Is that, do you still have any in a less adverse trade scenario? Could your 2.1% growth they had for 2025, can you still see that as plausible? I think it's going to be pretty hard, though, to get past.
Ed, you're shaking your head.
Not even close. It's not even going to be close. They'll be lucky to get one this year. So, there's a prayer and there's a forecast, and that one looks more like a prayer than a forecast.
Ed, Earl, what are your thoughts on the potential impact of a large fiscal project by the federal government, a rescue package for Canadian individuals, workers, and businesses who may be affected?
I think it's still early days and too early to tell, but I do think they're open, and I think a lot of the parties, depending on how big the shock is, will be open to that. But remember, the package has to be long-term thinking. I think we are in this issue because we've been very short-term thinking. So we have to ensure that we increase the certainty for companies to come here, in addition to helping the companies that are here if there is a big fiscal shock.
Okay, just to review, the Bank of Canada has cut its benchmark interest rate, the overnight rate, as expected, by 25 basis points to 3.0%. That's rate cut number 6 since early June, and has taken the overnight rate all the way down from 5% to 3%. The bank does warn of economic shock from a trade conflict with the United States. As expected, the bank has made those comments in its opening statement, and I believe in its monetary policy report as well. And there will be a news conference at 10:30 a.m. Eastern Time, which we will carry live for you, as we always do, in which Governor Tiff Macklem and Senior Deputy Governor Carolyn Rogers will take questions from the news media. Warren Lovely, has the bank done the right thing today?
I think they have, based on very imperfect information and sort of hypothetical and theoretical shocks. We will learn much, presumably, in the coming 3 days if the U.S. administration is true to their word. I like this point that Earl made, though. I mean, let's not kid ourselves. It's not like come February 2nd, we're in a world of certainty with likelihood of great traction. I think we really do face a number of structural headwinds in Canada. I guess what Churchill said, never let a good crisis go to waste. I think we're staring at a crisis. This is certainly going to focus attention of central bankers, the central bank, and government officials. Let's hope we make some lasting structural, maybe even nation-building changes here as we deal with a very antagonistic U.S. administration.
Earl, last question to you. The Fed also is due to make an announcement today. No change to rates is expected, but it's also expected to say something about the potential consequences of a trade war to the U.S. economy. We've got about 15 seconds for you to give us some kind of thought there.
Yeah, and I think they'll do similar to Canada in regards to maintain their flexibility. That is an important announcement. To me, that's what's going to drive the currency and the Canadian dollar strength or weakness today.